Before we start, Andy, I'd just like to say a quick thank you to our podcast sponsor, Fidelity International. Now, Fidelity is one of the best known investment platforms and global fund managers out there and is responsible for around £320 billion from over 2 million clients globally. Now, I currently use Fidelity's investment platform to run my own 80/20 investor portfolio, and they give access to ETFs, investment trusts, shares, and even unit trusts. For investors looking for ideas where to invest, then Fidelity also offer guidance, fund shortlists, alongside fund suggestions from their investment director, Tom Stevenson, who also happens to be a columnist for The Telegraph. Now, don't forget that you also have the option of putting your money in cash now, so you can secure your ISA allowance and make your investments later once you've made up your mind. Also, if you invest a lump sum in an ISA online by the 31st of March 2019, Fidelity will also give you the chance to win back your initial investment up to a total of £20,000. Now, if you want to find out more information, you can do so at fidelity.co.uk. Now on with the show.
Hello and welcome to episode 216 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, how are you doing?
I'm good. I'm very good, Andy. It's nice and sunny. That always makes me slightly more cheery, as I think it does most people. So yeah, I'm good. And we've had quite a lot of. Well, this week I was on Pete Matthews' podcast. So if you're a listener of our podcast, there's a very good chance you also listen to Pete Matthews' Meaningful Money podcast. And I've just done that. I've just done that annoying thing that everyone does when they mispronounce someone's name, because Pete's surname is Matthew, not Matthews. So yeah, sorry, Pete. But I was on his podcast, did an interview about Money MOT, and talked about a lot of other things, including Brexit and
the future of advice.
Which, as usual, I then proceeded to get a load of abuse from advisors for no particular reason. So all they do is show themselves in a very poor light, which I don't understand why they do that, because their clients can see. But hey, what do I care? So that was good, because I do enjoy talking to Pete. And yeah, I'm also buzzing because of next week. And well, next week I'm doing a live event in central London where I'm on a panel discussion about the future of home buying. We're going to be talking about investing. We're going to be talking about savings, and also about running a fintech disruptor. So we've got Habito there, we've got Nested, we've got Moneybox, and of course you've got me, and a journalist from City AM is doing the whole panel. It's a free event, so make sure you come, because I'd love to see as many of you as I can. It's on Wednesday evening, that's the 3rd of April. I think it starts at 6:30, am I right, Andy?
Absolutely, and get yourself down to the General Assembly in London. And the tickets are free. You just need to go on, if you put General Assembly, Habito, it will be the first link you come to. Click on the link, and it's a free event. Put in your email address, and it's a free ticket.
And all the details on our social media channel. And if you are slightly wavering, think, oh, that might be interesting, let me just tell you that as a season ticket holder at Tottenham of 20 years, the first ever game at the new ground is on Wednesday night, and I'm missing that, so I can do this event. So that shows you how dedicated I am to the cause. And not only that, I've actually refused my Crohn's treatment this week for my infusion that stops me, or keeps my Crohn's under control, because it often has a side effect of making me have a cold. So I wanted to not have that. So look, I'm going above and beyond. So I'd love to see as many of you there so we can take pictures and all that kind of stuff. It's going to be good. And if you are trying to get on the housing ladder, then you'll find it very interesting, because there's some good companies there who are changing the way or the future of buying property in the UK. But it's not just going to be property focused. I'm sure it's going to be your night. You can talk about whatever you want. So
I've lined up a question that I'm going to be asking the panel, so I'm looking forward to it.
Oh, right, okay. Well, Andy's going to be there. I think Justin may come, and Lauren as well. So we've got the whole team. Should we get on with the podcast?
Let's get on with it. What have we got coming up on this week's show?
We got 3 pieces as usual. There's one around. We did a spring cleaning thing last week. I thought it was quite nice. I know they're a bit naff and catchy this time of year, but there was one around cleaning your credit report, which I quite liked. I saw something come through on that, and I thought, well, I do know what, I'm going to look at that and give a few tips around spring cleaning your credit report, which we all should do once a year anyway. So it has got that definite spring clean feel. The next piece is going to be on investing, but what I'm going to do is I'm going to look at something that's slightly contemporary, because in the market the way it is at the moment, there are certain things that I look up when I get up in the morning and I check, or throughout the day, certain metrics and certain indices in the stock markets and bond markets, just to give a quick feel of where we are. And I've done a previous podcast which you can go back through and find, where I talked about all the indices and share prices that I have on my stock app on my Apple phone, and I look at, and some of those have changed over time. I want to pick out a number of them at the moment. So they are good for the future, but they're particularly relevant now. And the last piece on the pod, Andy, you're going to be covering that one.
Yeah, it's the power of negotiations, really. So just a few quick fire tips. I mean, it seemed quite relevant at the moment. It's 29th of March when we're recording this. This is meant to be the day that we were negotiating the Brexit. We all know what happened there. So really just a few tips to you as listeners as to how you can use the power of negotiation, whether it's a car, your salary, a house price, or just haggling with products.
And
like
as ever, I'll just be butting in while Andy's trying to do it.
Yeah.
So let's crack on with it. We'll do the first piece on spring cleaning your credit report. Now, there are a couple of things you can do. One of the big things, if you're going to have a credit check or you're going to apply for credit, where you look at your credit report, and one of the ways to try and improve your credit rating overall is to register to vote. So you need to be on the electoral roll, and you can do that by going to the .gov.uk/register-to-vote. So if you get on that electoral roll, that will help boost your credit report. Now, you don't have a universal credit score. We talked about that in the past. What happens, every lender gives you a score or rating themselves, which are going to be very similar methodologies of how they do it, but you have a report which they look at, and they will then look at your credit history and come up with a score. Being on the electoral roll is a positive. The next one is knowing how much credit you have. Now, you may have a limit on your credit card, so let's say you had about a 15 grand limit, then there is, generally speaking, a sort of optimum level of credit use. So if you're using your credit cards, you've got to be seen to be managing that credit well. So that means repaying it regularly, particularly trying to pay more than the minimum, never missing a payment. But also you're not necessarily maxed out, because maxing out your credit cards and being right at that limit means that you're actually struggling. Or even if you're not, that's the impression it gives to lenders when they look at your credit report. So experts tend to say, and who these experts are, I have no idea, but generally speaking, is using around 10% to 30% of your available credit limit. So on a 15 grand limit, that would mean about 4.5. So don't try and use too much, because that means you're managing your credit. If you have too much credit, then you're only using none of it, then you're going to go below that 10% level. I wouldn't beat yourself up about the numbers. There's been a lot of sort of dispute about those numbers when I've looked at this in the past. But just as a general rule, it's good to have somewhere between 10 and 30% that you're utilising and you're not maxed out on your credit card. So if you're not in that range, try and start repaying some of that debt. But also, that is relevant if you've got available credit that you're not using, which you might think closing all down. We did a podcast, I think it was about 3 or 4 months ago, about this particular topic, so go back and find that one. The other one is, if you've got something like a gym membership and you think, well, we've all done it. We've all had a gym membership. I think if there's anybody who's had a gym membership and not actually gone to the gym, I think that's the majority of people. If there's anyone who's not done that, I'd be amazed. And the idea of just going, I'm going to cancel my direct debit, I'm not playing ball anymore, they're not taking that money. That is all well and good because you won't pay the money. The problem is that you've entered into an agreement with that company. So if you don't play by the contracts, the T's and C's of the contract that you signed up to, you could actually start to impact your credit rating, because what could happen is those companies will come after you for the balance or for any unpaid money, and that will start to impact your credit rating. Now, I remember when I moved into my house many years ago now, more than a decade ago, I had bailiffs knocking on my door for about 2 years trying to chase payments from the last person who lived there, and I used to have to make sure my doors were locked, and it was ridiculous. But they will come and chase after some of this stuff. Most of it was related to parking fines, funnily enough, but they will sell on that debt to debt collection agencies, and they will try and come and get it. And the annoying thing is, it might not even be your debt, as it was in my case. Yeah. So I remember one day there was someone at the door about 8 o'clock in the morning as I was getting the kids ready for school. I'm thinking, who's that? And I looked out the window, the bloke disappeared, and I had a letter telling me that they're going to come around and take my stuff.
Wow.
Yeah, so
scary stuff.
I tell you what, one tip. You don't necessarily know where the person you've bought your house from is moving to. And I would always suggest try and wangle it, that you find out.
Yeah, bring it into conversation and say, if I ever get any post or anything, can I drop it off?
Yeah.
And then that way, I suppose...
Well, that's exactly what happened. And I found a ring in the house when I moved in and sent it to the person. I text them and they gave me their address. And
you should have kept it and pawned it and paid that to the bailiff.
What I did is, because I found out their address, I then just, everyone that came along, I was like, yep, there they are, they're over here, there they go. And then eventually stopped. So there you go. Leading on from that, of course, there's the element where you close accounts. And I mean, one of the worst ones are utility companies. You know, when you switch utility companies?
Oh, I know exactly that. I'm in that process right now and it's freaking me out.
Yeah, and the reason it's freaking Andy out probably is because it's quite unclear. There's the old company sort of being involved in terms of getting your meter readings, pass it on to the new company. You're going around in circles. You may owe money to them, but you might not. And you can, if you suddenly cut all ties with these old companies and cancel direct debits that were there, and you cancel direct debits, etc., then what can happen is if you owe them money, they're going to come chasing. And obviously, that again can start to impact your credit report. So some things take longer to close down. Even though you say, I've moved away, I want to move away, and you instruct them, it can take months before the whole thing trundles through. And that's just a process. So be patient sometimes and be realistic that you may end up owing them money or they may owe you money, but it's worth ringing them up and checking and seeing, even after the event, do I owe you anything? What's happening? Going back and logging in to your old portal that you had with that particular provider to see if you do owe them money or what is going on, because often you don't always get sent a final bill by email because they'll send you an email saying go and check the online portal, and you might not do that. So make sure you don't just sort of burn your bridges, because that could come back and haunt you. The final one is financially de-link if you need to. Now, there are such things you may not realise, but you can be financially associated with somebody. Now, that means that you've either got out credit or you've got joint bank accounts. That will mean your credit reports become linked. So if you've got a potential partner or a new partner who has terrible credit and you have particularly good credit, if you take out a joint bank account or get a loan together, suddenly you become associated. So you become financially associated and their bad credit report will start to impact yours. So there's plenty of people out there who keep their finances separate for that reason, because they might not be able to get a loan if they link them together. But what's important is if there's an ex-partner or a person that you were somehow financially linked with, you need to financially disassociate yourselves from them, which you can do, and you can do that by contacting the relevant credit agencies, so people like Equifax, Experian. So you need to go on their websites, they will tell you how to do it. So
will you need to speak to each one, or will they pass messages on?
You'll normally have to speak to each one. I found in the past if you want to do anything,
right? But
it's better to be safe than sorry. So yeah, go and contact each of the agencies and make sure you are disassociated with them. The main one is actually, if you're going to, I should have said at the start, is check your credit rating, or your credit report rather, every year. So as part of the Money MOT, one of the things we do in that is encourage people to do that, check their credit rating. And I keep saying rating, I mean report. Because if you don't, then you won't know if somebody has taken out credit in your name until you try and borrow money. And that happens a lot. If you've had your identity stolen, you won't know until it causes you a problem. And I did mine recently. I went and looked at my account. I did it on Noodle. So Noodle is in pot noodle. They, noodle.co.uk, they do credit ratings and reports. And they are free. And you can do it on there, and you can see if there's any problems. They will even sort it out for you if you flag them. And when I did it, there was one. It was something that was an address I'd never lived at that was on there. Obviously, wasn't causing an issue, but you need to make sure everything is correct and in order. And the other thing, as part of spring cleaning all your credit rating and report, is make sure you set up direct debits for anything that's related to credit, because you don't want to miss a payment. It's the worst thing you can do. If you miss a payment, it may be very sort of to you trivial amount and you do it by accident, but it can have such a negative impact on your credit rating that when you go and try and take out any credit, you'll be kicking yourself for ages. So I think always try and pay by direct debit if you can.
Find out how fit your finances are for free with Damien's Money MOT. With no registration required and no need to access policies or paperwork, you'll receive your own personal grade, together with a breakdown of where you should focus your attention, all in the time that it takes to boil the kettle. Crucially, you'll get to see how you measure up compared to everyone else, and even get your own tailored plan on how to improve your score. Simply go to mot.moneytothemasses.com. So sit back, relax, take Damien's free Money MOT. Go to mot.moneytothemasses.com to get started. and reward yourself with that cup of tea afterwards.
Okay, so we're going to cover investing now, Damien. You're going to talk about the things you look at now, the things that sort of get you excited when you're looking at the markets.
Yeah, the things that get me excited, Andy.
They are really. It's your kind of thing. You're very knowledgeable on this kind of thing. I look at.
There's a big hole. They're not coming out, Damien, you saddo. The things that rock your boat.
It's true though.
What it is that I don't listen to the markets all day, every day. I mean, trust me, I do it quite often and find out what's going on and read about it. But sometimes you need to take a step back because there's a lot of noise that goes on. There's a lot of contradictory headlines. So what will happen is a narrative one day that will be the equity markets are rallying because of some great news to do with trade deals. The next day they will tumble because of the exact same reason. Or we have the fact that the Fed was going to start pumping out, will keep interest rates low and stop tightening and stop unwinding QE. One day that's suddenly a positive, the next day that's actually a negative because they know something we don't. And so what it means is that you can just chase your own tail when you're trying to understand what's going on. So what I do is I flick open my stock app on my iPhone, and it's not the best app in the world, trust me. It's very limited in its functionality, but what you can do is you set it up, you can get a quick snapshot of the things what's going on. So I've talked about it on a previous podcast where I list all the ones I have, so I won't go through that today, but I will pick out a couple of them that I think are worth looking at now, because we're in a market where it's very much to and fro. We're bobbing back and forth with certain indices, and it's very difficult because everyone's waiting for something to happen. So let me give you a good example, is Brexit. Now, if you go in your stock app, it's the one that's got a code of GBP USD equals X. So that gives you the pound versus the dollar exchange rate, which is, as I talk about, $1.31. £1 equals $1.31. That's what that means. But with Brexit, I mean, every day, almost not every day, every minute, every hour, something seems to change and we're going back and forth. We don't know what's happening. A very simple way of seeing if things are going well or bad is to watch this particular index. Now, if we're going to be okay, the world and the UK are going to be fine, whether that means we don't leave or we end up leaving with a good deal. If that's going to be okay, then what's going to happen likely is the pound to the dollar exchange rate will go up, so heading towards $1.40. So that's a big jump. If it's all going to end in tears and we're going to crash out with no deal, it's going to break down below 130, probably heading towards about 121. So if the index starts to move up, you know something positive is probably happening. If it's moving down, then you know something bad is happening. And it's the volatility at the moment is incredible in there. So I just look at it like today, we've had in the last 24 hours things starting to plummet away. It was up about 133. It's now going down to that key resistance level 130. If it goes below that, that's a little bit of a negative sign. But the drop has been that we're starting to become a bit disillusioned with what's happening, and the chances of leaving without any deal at all have slightly increased. And so the first thing I do is I look at that, and then I think, has there been any wild moves today? And then if there has, then I'll flick on the news and see what's going on. The other one is the VIX. I talk about the VIX every now and then. It's generally the fear index in the market. It's actually a measure of volatility on the S&P 500, which is the main stock market in America. And the VIX, if you find that index, has been going up and down, but it's started to drop and it's heading back down towards not historically low levels, but recently low levels. So as I look today, we're down below 14. What I'm looking for at the moment is 15. Are we above 15 or are we below 15? If we're above 15, that's slightly bearish, possibly for stock markets. If we're below 15, as we are now, that's a positive. That could be bullish, because the fear's dropping out of the market. And so that level, we're flip-flopping around it at the moment. But if we go above it, that means the fear's creeping up. It does seem to me that we're probably going to have a pop in the VIX. It will jump higher, because there's a lot of stuff going on out there that is being underpriced, I think. There's Brexit, there's the trade deal that between the US and China that could go completely wrong. The level of economic slowdown in the world, I don't think that's necessarily being priced in as much at the moment in markets. So keep an eye on that, because if that suddenly jumps, then you know that spells trouble for stock markets. Another one is the interest rate on the 10-year US Treasury yield, which is got a code of TNX in the app on the iPhone. Now that's a 10-year US Treasury yield, so that's the yield you'd get if you lent the US government money for 10 years. Now that had been increasing into the back half of last year until the October sell-off. And since then, the yield has been falling. It was up above about 3.2%, and everyone was saying it was going to go to 4%, and the bond market was going to implode, and we're finally going to have the end of the bond bull market. But then things turned, and because of a possibility of a recession globally and in the US, bonds tend to do better in that environment than equity, so people buy them. And what's happened, that yield has started to come down, but in the last few weeks it's come crashing down, and we're now down at levels of 2.43, levels we've not seen in a very long time. But it's just that trend of going lower, and at the moment the bond market is leading the equity market. When you get a day where the bond market is down, the yield is down, then the equity market tends to be weaker. So I'm watching that because that shows the sensitivity of what the bond market thinks is going on, because often the bond market and equity markets will tend to have to agree about something at some point, but they spend a lot of time disagreeing, and one has to be right and one has to be wrong. So equity markets at the moment suggest that the world is amazing, everything's awesome, we're going to be having epic amounts of economic growth globally everywhere. Bond markets are saying, get your tin hat on, and at some point one of them's got to be proved right and one's going to be proved wrong. So jumping from that to the S&P 500, that is where we're going to probably see it first, because the market is up around a level of 2800 to 2825. We pulled back recently. If you watch the midweek markets video or listen to the podcast, you'll know all about it there. But I'm watching that particular index as well. I'm watching the futures, because they give you a sign of what the market is really thinking. We're very much still watching what's going on in America, and it's leading everything else. I mean, the FTSE 100, of course, I look at that. I'm at the moment looking at the 7250 level on that, because that tends to be a level where we then rally higher towards 7500. We did break above that 7250 level recently, but we dipped back below it. And a lot of that's around the value of the pound, which is influencing that. So there's some of the key indices that I'm looking at. I'm not so much looking at the other currency pairs at the moment, because I just think that there's so much going on with Brexit, and there's so much going on with the US stock market. They're key, and the bond market. But one other that I do quite like is obviously oil. So I'm looking at the price of oil, which is CL equals F on this app. And the oil price has rallied, and it's above $60 a barrel. And that is quite interesting, because we had a correlation at one point between the oil price and equity markets. But the price of oil tends to drop if we think there's going to be a slowing in economic growth, because we don't need as much oil for transport or plastics and all that sort of stuff. So keeping an eye on that, because that almost confirms whether we are possibly having a slowdown or not. And finally, just out of a sort of perverse interest, is what's going on in the Chinese stock market.
So I told you it excited you.
It does, because it seems to be, we've had some movement in the stock market in China recently pulling back, but it's the Chinese government and the People's Bank of China seem to be inflating that stock market, so it's almost doing its own thing, even if the rest of the world is dipping. That interests me, because how long can that last? And so I keep an eye on that, because it seems to be diverging. It's in quite a bullish trend at the moment. It's diverging from the rest of the Asian equity markets. If you look at the Japanese stock market, it's like been a car crash for basically since the beginning of last year, and almost every day it's going further down. So Japanese equities is one thing at the moment you don't want to hold. I did say that was the last one, but there is one other, and that's the German DAX. So that's GDAXI on the stock app, because I like to see what's going on there, because it's one of the key stock markets in the world, and there's always been a positive correlation between that and what goes on in America. And so if it starts selling off massively, then at some point you'd think that the American stock market has got to as well. So it's like looking for those similarities, those correlations, and where they're broken, because if the German stock market is tanking, that's not a good sign for Europe, and it's certainly not a good sign even for American stock market. So taking all those things in the round, I start looking at, can the American stock market keep levitating and being the one that is almost the outlier, because surely it can't be forever, or will everything else catch up? So I look at all those other bits and jigsaw puzzles and try and put them together.
Good stuff. And if you want to hear an up-to-date commentary of what's happening in the markets week by week, then do listen to our midweek podcast. It comes out on a Wednesday. It's called Damien's Midweek Markets, and there's a video that accompanies that too, which is available on all the socials and also on YouTube as well. So if it interests you and you want to see an up-to-date analysis of what's going on, get in touch with that. Right, what have we got left? It's me.
It's you, Andy.
Yeah. We're talking about negotiations. Now, Brexit, well, let's not even talk about Brexit, but that's the reason we're doing this piece. We obviously haven't been very good at negotiating as a country, so we thought we'd talk about negotiating in general. So it's just a couple of tips to start us off with on how to negotiate, and then we're going to look on how you can do that in terms of negotiating a pay rise, maybe negotiating house prices. Should we go for it?
Go for it.
First of all, set your expectations early. Now, there are pros and cons to this, but I suppose what we're saying here is be bold and just go out and set your expectations and say your desired outcome from the get-go. And then you've got somewhere to negotiate down to. It makes it clear. It makes it concise. You're talking about the whole topic. So you want to talk about say for example, you want 10%, then go in and say it's 10% you want. It's unlikely you'll probably end up at that, but at least it gets it out there and you're not pussyfooting around.
Pitch higher, because you can always negotiate down from somewhere. So if you start at what you want, do a Donald Trump. As much as everyone despises Donald Trump, including me, the one thing he does is he goes in, bullies everyone, tells them what they want. He never gets what he wants, generally speaking, but he ultimately gets what he wants because he ends up somewhere where he's done some form of mild compromise.
Otherwise, it's the elephant in the room. You end up spending 15 minutes talking about basically nothing because no one understands where they're at. It's about give and take. If you're not willing to budge, that's no longer a negotiation. That's basically a demand.
That's Brexit. That's what Europe did. That's why it's not a negotiation.
And you need to be prepared to win the war. What I mean by that is you're going to lose the odd battle from time to time, but if you want to win the war, so, maybe you have to give a little bit away before you can actually win the overall thing. Know your worth. So what I mean by that is spell it out, sell yourself, explain how you add value, and crucially, once you've agreed something, get it in writing. Going on to pay rises in particular, I think, Damien, you've got
I'll finish this off like this piece, because this is something that I've had in the past. I'm not saying I'm the best negotiator in the world. It's one of those things that everyone finds uncomfortable. But when it came to pay rises, there were certain things that I found would work. And if you go into a pay rise, you can't go into it basically just demanding something. You've got to go in, you need to know, like Andy said, your worth. So you can go out and find out what your worth is to the in the market, open market, what people get paid doing your equivalent jobs, and have evidence of that. You can't necessarily know what your colleagues are getting paid, but maybe you do, but then you can't enter that underhandedly into a negotiation with your boss. The other thing is you need to know, like Andy said, your worth. So if you can demonstrate your worth and the value that has to a company, then that is a real positive and why you should get paid. So in the lead up, the negotiation isn't about just that day. That you've got to be on the build up, being able to demonstrate this stuff so you can then pull out the evidence. And the reason you need to do that, so I'll come on to, is it makes negotiating far, far easier. So what I used to do, and it worked in a number of times when I did it, was getting people to empathise, because the problem is that people struggle at empathy. And if you're sitting there on one side of the table and you're sitting there with your boss and you say, I need to earn more money, and he's not wanting necessarily to give you more money, and I'm saying he, it could be a she, I'm just thinking of he because he's a horrible person, but the way I found is that if you start to demonstrate, so let's say, for example, that I've worked this amount of hours, I've produced this amount of work, which has generated this amount of business for the company's made much more money. You basically make yourself a linchpin, an important cog in the whole machine, and you can demonstrate how you've gone above and beyond, which they can obviously not refute. But then you get to the point where you say to the person, now if you imagine if you're in my position, you and me, and you've done all of that, and you're going to just get an inflationary pay rise of 1% or something like that, and which is the same as all the other people who haven't bothered, who've gone home early, done all these things. What would you think if that was you? And as soon as you get people to make sure they answer the question, they'll feel uncomfortable, but say, well, what would you think if you were in my position? If I did that to you, what would you say? And then the person, as soon as they do that, they answer, you've already won. Because the reason is that what you're doing is making them think like you. And as soon as somebody thinks like you and has an element of empathy, you're much more likely to get them to agree with what you're saying because they're thinking it from your point of view. So they'll go, I know what you mean. It's a real struggle, blah, blah, blah. And then they may see what they can do because they're seeing it from your point of view that it's unfair. I mean, one word I've never ever used in my life is unfair. I don't like it. I think it's life's not fair. If you say to people that's unfair, I should get paid more, that's just, to me personally, very juvenile way of looking at things. My toddler says that to me, it's unfair that she doesn't get stuff. So if you demonstrate to people that, how would you feel, what would your motivations be after you've got that? If I've just been told that information, how would you feel when you go back and work? What does that say to me about the sort of work I should be doing? Because you're saying I'm equally rewarded if I don't do it, so you're saying I shouldn't be doing this stuff. Very quickly, people are more likely to give you a concession. So it's not guaranteed, but it's about the art of negotiating things by making people, rather than be confrontational, it's being actually manipulative. There's no two ways about it. That's what it's about. So I'm not saying it'll work every time, but I know it's worked for me in the past when I've had to do something similar. I'm not the best negotiator by any stretch of the imagination.
Good. And well, that's basically it. A couple of very quick tips at the end is, look, you can't get sacked for asking for a pay rise. It's actually against the law. I know it sounds silly, but you're legally absolutely well entitled to ask that question. And do you know what? Be prepared to leave. If the negotiations don't go your way, they clearly don't see your value, the same value that you have in yourself. So yeah.
Yeah, and some of this we're talking about is particularly relevant to, I don't want to say millennials, but people who are younger, who aren't as experienced at the point of where they've asked for pay rises. Because I know there are a lot of you who listen as well. One thing you can almost be certain in life is you're never paid what you're worth, because companies have got to make a profit. So they very rarely pay you exactly what you're worth, because they've got to make, like I say, money. But the reason you know that, because almost always if you go to leave a job and you are that linchpin, you are that important cog in the machine, they'll suddenly go to you, can I give you a pay rise? Because don't forget, they're going to have to pay an agency probably several £1,000s in fees alone just to employ someone like you, but also probably pay that person more anyway. So suddenly they panic.
And the training costs and everything else is just spirals.
So that is all part of, that's on your side of the discussion and negotiation. And that to me is always a sad point, is that it's only when you threaten to leave that often than not, it's almost always been the case in my career that people then suddenly want to pay you. But a lot of the time, that is too late in my view.
And actually what they're doing there is they're actually admitting to you that they were underpaying you for all that time as well. Yeah. So it's a double blow, isn't it?
It's slightly insulting. Yeah. So you can take the pay rise and then leave anyway.
Good stuff. So if you've got any good examples of that, by the way, if you yourself have done some really good negotiating in the past, let me know. Drop me an email and we'll highlight it, because it'll be good to know. It's andy@moneytothemasses.com. So that's it. We're done on the podcast. Don't forget you can come along and see Damien on the Wednesday, the 3rd of April at 6:30. Check it out. It's all over our socials. We'd love to see you there. You can contact Damien @moneytothemasses.com. Twitter, it's @moneytothemasses with a number 2. And Instagram, we're all over that as well. And review us too.
Yeah, and so I'll see you on Wednesday.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.